So we are very fortunate to have a very strong labor market. There's twice as much vacancies as there are people unemployed. I wish labor participation were higher. I wish wages were stronger, but it is a strong labor market. I think what you're going to see is growth slowing, profits under pressure, and the labor market is going to do just fine to begin with. It is what happens next year to the labor market that's going to be key. But I think in the short term, this economy is supported by a very strong labor market.
If your concern is profits, if your concern is that corporations are going to have their margins squeezed as input costs go up and they don't necessarily have pricing power, then do you think the market has seen, the stock market at least, has seen enough damage, or do you think there's more to come?
Well, certainly profits are going to come under pressure from the revenue side. So far, they've come under pressure from the cost side. But there was comfort that many companies had pricing power. And they had pricing power because demand was strong. Now that demand is slowing, that pricing power is going to erode. I think it's key to differentiate between different companies and between different stocks. It's much easier for me to tell you a stock-specific story than it is to tell you a market-specific story. I have great confidence in those companies that have relatively inelastic demand and that have pricing power. They're going to be able to maintain their profit margins.
Is that anybody outside the energy industry at this point?
You have quite a few in tech that are able to do that, and you have quite a few in the real economy that are able to do that. So this is about name selection and about changing in your mind what are the key attributes for what's ahead. And what's ahead is inflation staying high, but demand starting to weaken.
Mohamed, when we talk about the Fed, it's not unusual. There have been a lot of critics, yourself included, just about how the Fed is slow to the game to raise rates. They've been slow to the game in the past. Unfortunately, the Fed is usually behind the curve in terms of stopping raising rates, too. And I guess that's what you've been referring to, how much damage gets done in the meantime. What is the Fed going to be watching most closely? Is it inflation numbers? Is it the consumer confidence? Is it the wage indications, what the average hourly wage is? Which one of these matters the most?
So for them, it's going to be the inflation numbers and particularly inflationary expectation. And again, at 10 o'clock, we're going to get some feel for that. Look at the last 12 months. And it's like watching a really awful movie over and over again. First, it was denying that we had an inflation problem. It took till the end of November to recognize that inflation is not transitory. While the markets, companies, and a growing number of economists was saying, wait a minute, let's be more humble about these inflation dynamics. Secondly, it was not tightening fast enough. They lost a lot of time in December, January, February, March. They could have tightened more, and the market ran ahead of them on this. Now, the market is saying, you know what, you're so late that I don't think you have enough skill and luck to compensate for how late you are. So this economy is going to slow down significantly. And that's the third time that the Fed has lagged reality in the last 12 months. And that's problematic for the real economy. It's problematic for the Fed itself in terms of credibility and in terms of forward policy guidance.